Okay, trading charts. Japanese candlestick charts. The most common method of representing price action on Forex charts is by using Japanese candlesticks. Below you will see a chart of the currency pair USD CHF. The green and red bars are the candlesticks. So candlesticks is a way of representing price on a chart. As you can see over here, we've got a chart with candlesticks on it. The candlesticks are the green and the red bars. So just like a line chart or a bar chart, which you obviously would have learned of in school, represents data. A Japanese candlestick chart also is just a way of representing data, and it is one of the easiest ways of representing data within the Forex market, and one of the easiest ways or methods to analyze the Forex market. So we can go into what is Japanese candlesticks. So Japanese candlesticks is a visual representation of what the market is doing over a certain period of time or time frame. Those time frames are MN, right, where each candlestick represents 1 month, or also known as a monthly chart. So what that means is that when you have a chart in front of you that shows a currency pair and shows a whole lot of different green and red bars, there's all the different candlesticks in front of you. When you are on a monthly chart or monthly time frame, one bar or one candlestick represents what happened over 1 month. So if it is a red candlestick which shows a decrease in price, that means that for that month price has decreased. If it is a green candlestick, it would show that price went up during that month. Okay, we then have W1, right, which is the same explanation, but W1 would just be a weekly chart, or where one candlestick would represent what happened over 1 week. D1 shows you what happens over 1 day, which is also known as a daily chart. H1 shows you what happened over 4 hours within the day, and that is known as a 4-hour chart. H1 shows you what happened within the hour or the 1 hour, and that is known as a 1-hour chart. M30 is where each candlestick shows you what happened every 30 minutes of the day, and that's also known as a 30-minute chart. Then we've got M15 where each candlestick represents 15 minutes, which is also known as a 15-minute chart. Then we've got M5 where each candlestick represents 5 minutes, which is also known as a 5-minute chart. We've got M1 where each candlestick represents 1 minute within the market, and that is known as a 1-minute chart. Okay, so now we can go on to the types of candlesticks. Okay, types of candlesticks. There are 2 types of candlesticks, namely a bearish and a bullish candlestick. A bearish candlestick is a negative candlestick, bullish is a positive. These 2 names, or why these 2 candlesticks are called bearish and bullish, is because when a bear, the animal bear, pounces, it usually pounces downwards. It will jump up and pounce on top of something downwards. A bull, when a bull charges, he would usually charge upwards, right? He would charge with his horns upwards. So that is what the bullish and bearish candlesticks represent. So bearish meaning downwards, or that's bounce movement. Bullish meaning that increase or charging upwards. So a bearish candlestick is red and it represents a decrease in market price or a downtrend within the specific time that the candlestick represents. A bullish candlestick is green and it represents an increase in market price or uptrend within the specific time that the candlestick represents. So over here we've got the explanation or description of a candlestick, what exactly a candlestick shows you. So over here we've got a bullish candlestick. The solid part of the candlestick is called a body, right? The 2 points at the bottom and at the top is known as wicks. The same for a bearish candlestick as well. We've got the body and then we've got the wicks. When a bullish candlestick is formed, it usually forms at the beginning of a specific time frame. So if this was on a 1 hour chart, then the previous candlestick would close at the end of the hour, and this specific bullish candlestick would open or start at the beginning of the hour. So it would start with the other one ended. So over here it says open. The opening of a bullish candlestick is represented by the bottom of the body. So that would be this over here. Over time during that hour, price would then increase and decrease, right? That is where the wicks comes in. So over here, if for example the market opened within this hour, the price opened over there, right? During the hour the market would move down to this point over here, fluctuated in between, and then moved up to that highest point over there. So that is what the wicks represent. Wicks represents where the market has been within that specific time frame, or within that specific time that candlestick represents. So over here it shows us that during the hour the market went to an extreme low, right, where price was at its lowest during that hour, lower than where it opened, but also within that hour price went up and went to its highest point within that hour, but then moved down again and decided to close at this level after the hour, right? So the difference between the open and the closing price would be the body. The wicks on the top and the bottom would then just show you where price was within that hour. Right, so it will show you the high and the low. Same for a bearish candlestick as well. So now we can move on to candlestick patterns. Candlestick patterns. When certain candlesticks form after each other, it results in a candlestick pattern forming. These patterns appear all over a chart and represent whether a trend is ending and the market could possibly be reversing or starting a new trend in the opposite direction. For this module, we will not be focusing on all candlestick patterns, as bull effect trades with only a handful of important patterns in order to be profitable. The very basic of candlestick patterns is the engulfing pattern below. An engulfing pattern is when one candlestick, the bearish or bullish candlestick, engulfs the candlestick before it. An ideal engulfing candlestick should be at minimum double the size of the previous candlestick body that it is engulfing. This pattern represents a strong continuation in trend or confirmation of a new trend that has been formed. Right? So for a bearish or red engulfing candlestick, it means that price is going down and a downward trend could be forming. For a bullish or green engulfing candlestick, this means the price is going up and an uptrend could be forming. So over here we've got bearish engulfing, right? This is the engulfing pattern. This would be these two candlesticks. We've got a green and a red candlestick. That is one engulfing pattern. Then we've got other two variations of the bearish engulfing pattern. You need to familiarize yourself with this as this is very important when doing analysis and finding an entry point within the market. The same with bullish engulfing. We've got three different variations of the bullish engulfing pattern. Over here, you can see this is the pattern with the red and the green candlestick. The green candlestick body is engulfing the red candlestick body. So this shows that there is a strong movement upwards. The same with these other two variations of the bullish engulfing pattern. So now that we've been over the basic of candlestick patterns, or one of the most basic candlestick patterns, we've now got other important candlestick patterns that we also have to look out for. So our first one would be the doji. A doji is seen as a reversal pattern because the opening and the closing price is at the same place. When this happens, it usually means that there is uncertainty in the market and the bulls and bears, or buyers and sellers, are fighting against each other. So when this pattern appears, it means that price has, obviously this would be 2 weeks on the top, and this would be a week at the bottom, and the horizontal line that you would see in the middle would represent the body. But it would have no specific color because it was the same place where the market opened in the beginning of that hour or in the beginning of that specific time frame. The market closed at that price, so the market neither increased in value or decreased in value. However, the wicks represent that the market did move up within that hour and moved down within that hour. However, at the end of the hour, the candlestick closed at the same price at which it had opened up at in the beginning of the hour, which then leaves uncertainty for that hour. Dragonfly Doji. This specific doji can be seen at the bottom of a trend and is considered to be a bullish indicator. When the opening and closing price is the same, the long wick at the bottom shows the market might change direction. So what this shows you is when a market is moving in a downtrend, right, and the market starts slowing down and it looks like it's going to start to form an uptrend or a bullish trend, we would then find a reversal pattern which would contain a dragonfly doji. So a dragonfly doji shows you that the market reached a far way down by this long wick at the bottom, right, and the short wick at top on the top. So it shows you that the market tried to push down within that specific time. However, the market moved back up and closed at the same price that it opened at. So it moved a far way down, however it could not sustain that momentum to the bottom. And then it closed at the same higher price where it opened at. And after that, we would then often find confirmation of a trend that would then start moving upwards. Gravestone Doji. This specific doji can be seen at the top of a trend and is considered to be a bearish indicator when the opening and closing price is the same. The long wick at the top shows the market might change direction. So just as we explained with the previous doji, this long wick at the top shows that the market reached a long way to the top or increased in price, however it could not sustain its momentum, and then it dropped back down and closed at the price that it opened at within that specific time. And if it reached a far way up but couldn't maintain that momentum to the upside, this specific candlestick pattern would then give us an indicator that the market might start dropping just because it couldn't hold its momentum to the upside. Spinning top. A spinning top is a strong indication of a market reversal that is about to happen. usually indicates no certain direction of the market. We then wait for a secondary pattern, such as an engulfing candlestick, which often shows a strong momentum in whichever direction, to form to confirm the direction of the market. So as you can see, a spinning top has an equal size wick to the upside and to the downside, with a small body in the middle. So this is a candlestick that shows a bit more direction than the doji. The only difference is that there is a slight difference between the open and the close price. However, the market did reach the same distance upwards as what it reached downwards within that specific time frame, and the market is still unsure about where it wants to go. It's neither forming a strong candlestick that is showing us direction to the upside or direction to the downside. So this candlestick still represents uncertainty in the market. As it says here, this would have to be followed by another secondary pattern to indicate the direction of the market, and that would most probably be an engulfing candlestick or a pattern that would contain an engulfing candlestick. Tweezer top or railroad pattern. These are two candlesticks with an even or matching top. The top of the bodies matches or lines up. This pattern is found at the top of a trend as an uptrend is coming to an end. So as you can see, we've got a tweezer top over here. It shows, this arrow shows that the market was moving up. Then we have a tweezer top that forms, right? The green candlestick, the top of the body, and the top of the body of the red candlestick are even. However, both bodies of the two candlesticks are fairly long. That then forms what we call a tweezer top, and this is a strong indication that the market will start dropping. Usually, if it is a tweezer top, the red candlestick body has to be slightly larger than the body of the green candlestick to indicate that there is more momentum to the downside than there is to the upside. With a tweezer bottom, it would just be the opposite. As it shows over here with this arrow, the market was coming down. We then formed a tweezer bottom where the bottom of the red candlestick and the bottom of the green candlestick are even. However, the size of both candlesticks are fairly long and the market is starting to move upwards. The morning star pattern, or the start of a bullish trend. A morning star pattern is made up of three candlesticks. The first candlestick has a long red body. The second is small and gaps slightly below it. The third is a long green candle that fits in more than 50% of the first candlestick. So over here we've got a bullish morning star, the three candlestick pattern. So it shows that the market was coming down by this long red candlestick over here. We then have a hammer candlestick which forms in the middle, followed by a long green candlestick. This candlestick is, or this green candlestick over here, is bigger than 50% of this red candlestick. So this forms a bullish morning star pattern, and this shows us that the market is most likely to start moving upwards. Right, then we've got the bullish morning doji star, which shows us a similar pattern. However, the candlestick in the middle is not a hammer, it is a gravestone doji that appears, and As you can see, the green candlestick body is more than 50% bigger than the red candlestick body, and this indicates a bullish pattern, so the market would start moving upwards from there. Evening star pattern, or the start of a bearish trend. An evening star pattern is made up of 3 candlesticks, just like the previous pattern that you saw. The first candlestick has a long green body. The second is small and gaps slightly above it. The third is a long red candlestick that fits in more than 50% of the first candlestick. So over here we've got a bearish evening star, so it shows you that the market was coming up by the long green candle. We then have the smaller green candle that forms in the middle, and then followed by a long red candle to the downside. And the long red candle is bigger than the first green candle. Same with the bearish evening doji star over here. So you can see that the middle candlestick is replaced with a doji, and this now shows us that the market is starting to trend downwards with the long red candlestick we've got over here. So just pay attention that these are 3 candlestick patterns, and you have to have these 3 candlesticks for the pattern to be valid. Hammer, or the start of a bullish trend. A hammer is a very strong reversal signal. The wick of the hammer must be double the size of the body for this candlestick to be considered a hammer. A hammer needs to follow with a strong bullish candlestick to confirm the new direction of the trend before entering the market. So, as you can see, the market was coming down based on these 2 red candlesticks. We then have the small green candlestick that forms with a long wick to the downside. This is called a hammer candlestick. As you can see, it actually looks like a hammer with a body at the top and a long wick to the downside. This candlestick is then followed by 2 strong green candlesticks. So this pattern that forms over here, we then call a hammer bullish pattern, right? With the long wick of this green candlestick that is pointing to the downside. So what this hammer candlestick represents is that the market tried to reach to the downside, but it could not maintain momentum to the downside, but then closed to the top of the candlestick, where we've got most of the body being at the top of the candlestick, followed then by 2 green candlesticks, which now shows you that the market is starting to trend upwards. The same with this candlestick pattern over here, which is also a hammer candlestick pattern. We've got 3 red candlesticks coming down, of which the third one is a red hammer, or a bearish hammer, with a long wick to the downside that shows that the market tried to reach downwards but could not maintain momentum to the downside. It then closed to the top side of the candlestick, which then formed a body on the top, and it is now followed by an engulfing candlestick and an engulfing green or bullish candlestick and another bullish candlestick. And this shows us that the market is now starting to trend upwards. Inverted hammer, or the start of a bullish trend. An inverted hammer is a very strong reversal signal. The wick of the inverted hammer must be double the size of the body for this candlestick to be considered an inverted hammer. The same that we explained previously with the standard hammer pattern. So the inverted hammer needs to follow with a strong bullish candlestick to confirm the new direction of the trend before entering the market. So as you can see over here, the market would have then been moving downwards with this 2 red candlesticks. We then have a hammer that forms in the middle. However, the wick is now facing upwards, showing that the market tried to reach upwards but then closed to the lower side of the candlestick, where most of the body is at the bottom of the candlestick, and then followed by two green or bullish candlesticks. This now shows us that the market is starting to trend upwards. We've then got the other variation over here, which is three red candlesticks, of which the third one is the hammer, which is inverted, with a wick showing to the inside or the upside, and then followed by two green or bullish candlesticks, which now shows us that the market would then start trending upwards. Shooting star, or the start of a bearish trend. A shooting star can indicate the end of an uptrend and is often retested by the market. Once formed and the market starts to form a downtrend, the market will often move back up to the price level where the shooting star formed. Only then will the market continue to a valid downtrend. So as you can see, we've got a shooting star pattern over here with two green candlesticks representing the market moving upwards. We then have a candlestick with a long wick to the upside, and followed by two strong red or bearish candlesticks. Right, this is a shooting star pattern. The same over here on the other side. So when it says that the market will come back up to retest the level of the shooting star, this means that if these two candlesticks represents the market moving upwards, and we have this candlestick with a long wick at the top, and then the market starts moving downwards, the market will often move back up to this level over here, and then the market would drop downwards. And once the market drops downwards from there, that would then confirm to us that the trend is indeed bearish. The same with the variation over here.